record, and I'll turn it over to Katie and Sam with Lutz to get us started. Thanks so much for being here.
All right, thanks, Abby. Welcome all. The topic of our discussion today is going to be financial statements for not-for-profits. It's pretty high level, and then pretty high level overview of the financial statements and what all the different descriptions need, and a bunch of accounting issues that come up and how you review your financial statements if you're a board member or if you're the executive director or the controller of the group. So my name's Sam Addy. I'm a partner at Lutz, and I'm the head of our not-for-profit practice. And to my left is Katie Byrd. She's an audit director, and she's very involved in our not-for-profit practice. Just a brief overview of Lutz. We're the largest CPA firm in Nebraska. We have about 300 plus CPAs and 300 plus employees. We have offices in Omaha, Lincoln, Hastings, and Grand Island. On top of the CPA firm, it does generally audit and tax and client accounting service work. We also have a technology group who does mainly managed services. We have a talent group, which is an employee search group for all types of employees, specifically focusing on accounting. And we have a registered investment advisor, which manages investments for personal people and for personal purposes, as well as we are in foundations and all that. And we have about 1.1 billion under management for that. So I'm going to pass it over to Katie, and she'll go through our agenda and kind of get things started. And as Abby mentioned too, we'd like this to be as interactive as possible. If you have a question, you can unmute and ask a question, or do it in chat, and we'd be happy to try to answer those. And again, thank you all for attending.
All right, well, we're going to get started here. As Sam mentioned, if you guys have any questions as you go along, or as we go along, feel free to put them in the chat. We'll be checking that, every couple of sections, as well as we've got some time at the end for questions as well. So definitely, send those our way. We have a lot of experience between the two of us in the nonprofit world, and we've seen a lot of different scenarios between the two of us. So on the agenda today, first we're going to go over the importance of having quality financial records, have a general overview of nonprofit financial statements and how those differ from a for-profit financial statement. Then we'll cover the big three financial statement considerations, evaluate how to evaluate those financial statements, and then a brief section at the end on what to consider as a board member. So question number one, why do we care about financial statements? Sam and I work in financial statements on a regular basis, but as you guys are, going about the daily operations of your nonprofit organization, the question might be, why? First of all, financial statements are a really great way to communicate the mission of the organization. There's a lot of different ways you can communicate that mission. But it's a good way to show, the programs, where the dollars are going. Ultimately, financial statements are numbers, and numbers are an objective way to measure performance. So having numbers in place and having them in a readable format is a good way to kind of, take a 100-foot view of how your organization is doing financially. Particularly, financial statements reflect how the resources of the organization are being used. So, when you have money coming in from donors, the financial statements of a nonprofit can really push those to show how that money is actually being taken into the organization and how it's being used for the organization's mission.
Right. I think another thing too is, especially as Katie mentioned, they're a really good tool for your board of directors and or potential donors to show, it's easy to do internal financial statements, but when you have a separate set of audited financial statements by another company and done on a GAAP basis, it shows that the mission, you guys care about your mission, and also it gives better comfort that the money is being used in the way it's supposed to be used.
So those of you on the call might be familiar with the nonprofit financial statements, or you might be more familiar with just, for-profit financial statements. So some of the differences here, the three main for-profit financial statements are the balance sheet, the income statement, and the statement of cash flows. A nonprofit organization has the same three types of financial statements. They just are called something different. So the statement of financial position is the nonprofit version of the balance sheet. The statement of activities is the nonprofit version of an income statement. And the statement of cash flows is the same for both a for-profit and a nonprofit. Really, the main difference between the two is the nonprofit also has a statement of functional expenses. And we'll get into detail later as to what that entails and why that's important for a nonprofit. So the statement of financial position, or the nonprofit version of a balance sheet, is an evaluation at a specific point in time for the organization. So, it's really a stake in the ground look at one particular date of, the assets and liabilities held by the organization at that time. Accumulated over time, you have your net assets, and we'll talk about some of the important things to evaluate with net assets. But really, what the statement of financial position can tell you is, one, what's left over after all the liabilities of the organization are paid, and two, liquidity of the organization. So how much, if you guys were in, dire financial need, what could be liquidated to be able to turn into cash on an easy basis. A couple other things, and we'll cover some of these later. Pledges receivable, net assets with donor restrictions. And the last one is restricted cash. So this is more common in the nonprofit world than what we see maybe in the for-profit world. Sometimes there's cash balances that the organization has to hold for a specific purpose. And that information is maybe not as easily known unless you're looking at it and it's specifically in a statement of financial position. So that helps the organization see, what cash and what assets do we have that are just available for whatever purpose is needed, and what assets and what cash is there that has to be used for a specific purpose.
I think another thing on the net assets item in bullet point number 2, that would be for a for-profit when people talk about equity. Your net assets at the end of the day, your assets minus your liabilities is the equity of the organization.
And this is just an example of what a statement of financial position might look like. You can see, in this particular example, there's a comparative version of December 31st, 2020 versus December 31st, 2019. Something that I find to be a really important way of measuring your financial statements is to evaluate them in a comparative manner. So if you were to just show me these December 31st, 2020 financial statements, sure, it does provide value to an extent, but it really provides value when you're looking at it in comparison to December 31st, 2019, because you're able to see, year over year, month to month, quarter to quarter, whatever evaluation period you're looking at, it really starts to paint a picture of what's going on in the organization. The next piece here is the statement of activities. So like I said, this is the nonprofit version of the income statement. It is broken out typically a little different than what you might be used to on a for-profit income statement. The top section is any support and revenue. This includes investment income as well. Second section is the expenses, and then that gets you down to a change in net assets. A unique piece of the statement of activities, we talked a little earlier about with and without donor restrictions. Those are actually separately shown on the statement of activities, which again just helps provide a clearer view to the organization and the users of the financials of what money that's coming into the organization is.
Did you
There we go. We got you now.
Oh.
So it helps paint a picture for the organization of what assets are coming into the organization that a donor is giving you for a specific purpose. And we'll get into this a little later, but it's really important to understand these donor restrictions that are coming in. Specifically, you might see, let's say you have $1 million of contributions during the year, and 100,000 of them are unrestricted and 900,000 of them are restricted. That might be fine for the organization type that you have, but it's something to understand why those are being restricted, what restrictions are being placed on them, and how that impacts your organization. Having lots of donations with donor restrictions really keeps the organization from having its own free will as to how those donations are being utilized. A key takeaway from the statement of activities, because I think this can really get confusing, a negative change in net assets doesn't mean that your organization has negative results. That might be something that's planned, perhaps just because of the way that donations are recorded on a nonprofit organization, you might still be positive in cash flow, but you might, from a GAAP basis financial statement, your change in net assets might be negative. So it's really just understanding what that means, and kind of asking the questions of why there's a negative change. Because again, we don't want you to think that if you have a negative change in net assets that things are going south for the organization. Conversely, a positive change in net assets may not mean that your organization is flush with cash at that point. Just because of the manner in which things are recorded, revenues might be taken in, but that doesn't necessarily mean that the cash is coming in the door that year as well. Oh. Sorry, I think we're frozen here. There we go. Okay, so attached, or this is an example of the way the statement of activities might look. So as I mentioned, you've got the without donor restrictions section, the with donor restrictions section, and then the total. So again, this is just, painting a picture for the year of how revenue is coming in the door and whether or not the donors have placed restrictions on those items.
A note of interest on here, and maybe someone can speak up if they'd like to. You see the line item called in-kind contributions. That's a non-cash contribution, and a lot of times it's if someone's donating goods to you. We have food banks where they get donated food and they record the value of those in-kind contributions. Also, they can be in-kind contributions with people donating their time, but generally the only time we record an in-kind contribution of people donating their time if they're giving you a specialized service. If people are showing up just to volunteer and help, you're not going to record the revenue on that because it's not a specialized service. But if someone's offering medical care or something for your organization on a free basis, then you'd have to estimate the value of those services. Does anybody on here record in-kind contributions or want to speak up about them?
We do for our annual summit. We have someone who usually does some video donations for us. They'll a company that shoots some video, edits, produces that for us. Right. So on our summit budget, that's included as an in-kind donation.
Right. So that's a specialized service that just not anybody, quote unquote, off the street can prepare. So sometimes in-kind contributions do not get recorded, and if you have an audited financial statement, your auditors are probably going to be asking about that. So just to note that, and the value of that is pretty much kind of an estimate of what you think that value is on a fair market value, and that can be discussed with your accounts as well. So it's not a perfect easy number, but just to let you know that that's what that generally means.
And the importance of having that in-kind contribution number, and just as a note, the offsetting item to that is an in-kind expense. So you've got a net zero impact to the bottom line of the financials or to your change in net assets number. But the reason that's important is because those are dollars that would have had to have been spent had they not been donated to you. So Sam used the example of a food bank. So if a food bank is getting donated a bunch of food to them, they want to reflect that as an in-kind contribution and in-kind expense. Because if for some reason one year nobody donated any food to them, they still need to provide food to their end users. And so they would have to go out and buy that food. So it helps, keep things comparable on a year-over-year basis, as well as it's still reflecting value that's coming into and going out of the organization. The last one on here, the statement of functional expenses, like we mentioned, this is unique to the nonprofit world. What the statement of functional expenses is doing is taking all of the expenses for that year for the organization and classifying them into 3 different categories. The 3 categories are your program expenses, so funds that are being spent directly on the mission of the organization. Management and general expenses, which are, any of your overhead costs, and then fundraising expenses, which are obviously pretty self-explanatory. Obviously you want the majority of those functional expenses to be classified in the program expenses category. As a user of a financial statement, that would be something that I know a lot of donors are looking at, is making sure that, when money comes in the door, are you actually using it to further the mission of the organization versus, spending a bunch of money on, back office things. That isn't to say that, management in general and fundraising expenses aren't important. If you've got 100% of your expenses going towards your programming, well, you're not probably then preparing yourselves for the future. So management and general expenses are important from an administration and, furthering the organization perspective. And fundraising expenses are important to maintaining and building a new donor pool. The functional expenses is something that covers a specific period of time. I will tell you just from, our work that we do here at Lutz, the functional expense statement is something that we usually assist with quite a bit, but I think it's something that's really valuable internally as an organization to understand how those functional expenses should be getting broken out, because it really helps give you a nice overview of how the money in your organization is being spent.
Yeah, I think the biggest thing we always see is on the salary and benefits line. If Katie goes to the next page. On the salaries and benefits line, total salaries for this number is 983,000. And how do we allocate them between program management, general, and fundraising? And the biggest thing we see is there is estimates in this. There's an executive director. They don't just allocate all their time to management in general, because a lot of time they're doing programming stuff. So we go through with the client and try to figure out, okay, let's figure out a percent of their salary should be allocated to program, and maybe percent of their salary should be allocated to fundraising as well. Same thing when it goes with depreciation. Depreciation is going to be $457,000 in total. However, if you're in one building that does programming and also houses your management in general, you figure out based on maybe a square foot or some sort of other percent of how you allocate those expenses. I think the biggest caution thing we have is when we're auditing the financial statements, it's easy to just say everything's programming and we have very little management in general. So we tell people, quote unquote, don't get too greedy with that. You use kind of the benchmarks. And a lot of times we're expecting to see program to be about 65 to 80%, and management in general about 10 to 20, and fundraising about 10 to 20 as well. So, and those you'd add them up to about 100. So that's something. A lot of the times the estimate salary and benefits on who's doing what, because the executive director could be wearing 3 hats, working on management in general, program, and fundraising.
And the important thing here really is just understanding your organization. So some organizations, for example, the AICPA, which is the Institute for CPAs, they probably don't have to spend as much of their time and energy on fundraising because of the nature of that organization. People are paying them a fee annually to be a member of that AICPA organization. Conversely, if you have a nonprofit that relies heavily on donations, more of that money is going to have to go towards fundraising. So a lot of this plays into, you know, really knowing your organization and what its needs are. You've heard us use the words GAAP basis. Really what that is, it's generally accepted accounting principles, but it's accrual basis. So you're trying to record contributions when the promise is unconditionally made, and you're trying to record expenses in the period the expense is actually incurred. This is different than cash basis, and both of them have their value. And we'll kind of give an example in the next slide of how these two differ and why it's important to understand both. A lot of organizations, I would say, start out on a cash basis because this is helping them show from a cash management perspective what cash has come in the door, what cash has gone out the door. Kind of the limitation of this is if you have, you know, let's say Sam's organization has committed to pay $500,000 over the next year. Well, as an organization, you want to know that that commitment is out there. So if you're recording on a cash basis, that doesn't show up at all. If you're recording on the accrual basis, that's going to show up as a liability. So it helps when you're using those financials to see, you know, what have we already committed to paying or what has already been committed to us as a receivable. So we have an example here. It's just an example of, you know, a donor pledge that's coming in 4 installments and 1 installment has been received. So you can see in this example on a cash basis, we're going to record $250,000 of cash, $250,000 of revenue. That's great, but as an organization now, you don't know just from looking at this that there's another $750,000 that's going to come in the door. What also looks different though is obviously in year 1, you're showing $1 million of contributions, but only $250,000 has come in the door. So you have to look at this as kind of a whole picture, but the reason the accrual basis is the preferred method is you're still showing a pledge receivable amount, so the organization can plan for the future by seeing that that amount is still out there.
I think one thing to remember on that pledges receivable, that is a non-conditional pledge receivable. That's just someone said, I'll give your organization $1 million to do what you wish in four installments or over 4 years. But if there's conditions tied to that, where it's based on a capital campaign and all that, that's recorded differently. We'll go through that later as well. But that does, this amount here makes things look a little different. As Katie said, if you look at your statement of activities for that year and you're on an accrual basis, you're going to see revenue or income of $1 million, but really you've only received $250,000 of cash.
And then kind of seeing this on the other side, you know, let's say you're paying $30,000 for a 3-year software contract. Well, in year 1, on a cash basis, you're going to recognize $30,000 of expense, but maybe the 3-year contract hasn't even started. So on an accrual basis, we wouldn't show any expense, and we'd show that expense evenly over the next 3 years. Why this is important is from a budgeting perspective. You know, let's say the only year that you're looking at from a cash basis is this year 2 example below. Well, we're showing 0 expense for software. Well, that's not really accurate. You know, if you were doing this on an annual basis, you'd have $10,000 worth of expense. So it's easy for things to slip through the cracks if they're being paid for, you know, in advance. So having things on an accrual basis helps maintain some consistency year over year versus, you know, being really impacted by payments that are made, you know, maybe they're made a couple days early or a couple days late, and it really throws off, you know, what we're evaluating from a statement of activities and statement of functional expense perspective. All right, so the next piece we'll go through, now we've kind of gone through, you know, the basics of the financial statements. We'll go through 3 of the main financial statement considerations. So the 3 pieces that, you know, in our minds are really important to understand from a nonprofit financial statement are the pledges receivable and promises to give, the net asset classifications, and the functional expense allocation. So pledges receivable or promises to give, this reflects, as we kind of mentioned previously, amounts that have been promised to the organization that haven't actually come in the door yet. So this really helps from a future cash management perspective to know what's going to be coming in the door. But as Sam mentioned, something that's kind of confusing with this, and trust us, we see this a lot, and it is very confusing and it's very situational. There are unconditional pledges and there are conditional pledges. So a conditional pledge is basically when the donor is telling you, we'll give you money if, or dependent upon. So there is something that has to happen in order for you to, earn that money. So a really, really common example that we see is for organizations that are undergoing a capital campaign. Maybe you're building a new building. A donor might come in and say, we'll give you $1 million once the certificate of occupancy has been received for that building. So when you get that pledge, you have $1 million coming. However, the donor has placed a condition on it, which is the certificate of occupancy. So the revenue, even on an accrual basis, doesn't get recorded until that certificate of occupancy has been received. So, when we think of a for-profit organization, everything is an exchange transaction, right? I'm going to give Sam this widget and he's going to pay me money. There's an exchange happening there. I have to do something in order to get the money from Sam. It's kind of the same concept. You have to do something as an organization in order to receive the value from that donor. And like we said, this gets very, very confusing. So just knowing kind of, when you're looking at any donations that are coming in the door, kind of have this, trigger in the back of your mind of, if it feels like we have to do something in order to get this money, then maybe this is something that we need to take to our accountants to kind of, have them help us out with.
Right.
Similarly, there is promises to give and there's intentions to give. So, a promise to give is generally pretty formal. It's coming from a donor who says, we will give the organization $100,000 every year for the next 5 years. An intention is more the language of we intend to, or we might. It isn't really a formal promise. Typically, from a conservative basis, we would say not to record intentions to give until they become promises. Sam could walk into an organization and say, man, I really like your organization. I want to give you $100,000, and then never give that $100,000. So, I would say be conservative. Technically, you don't have to have a formal written document in order to record pledges. On our end, we would say to be conservative and wait till you actually have a formal written agreement or some sort of documentation in place, because it's really hard to support or substantiate a pledge receivable unless you have something in written form.
Right. I think the biggest thing too, even if it's written form as well, on all these pledges and promises, we still every year have to evaluate which ones we think are going to be collectible or not. We don't want to overstate our receivables or our revenue to give the readers of the financial statement a false notion that all these pledges receivable are completely collectible. So that has to be something that's analyzed every year. The biggest thing where Katie was saying, if we just have a verbal pledge and recording receivables $100,000 and revenue of $100,000, you really need to explain what that is, and you don't want to mislead people thinking they got $100,000 coming in guaranteed when it's really just a verbal pledge. So that, again, that's all kind of guesswork and estimates, but just be on the lookout for those things, and it does get pretty confusing.
And there are some CRM systems out there that kind of help with tracking. Our recommendation really is just make sure that you have some sort of manner of tracking every pledge that you have. This is the best way to keep track of conditional pledges as well. I know I have a client that keeps track of every single pledge that they have. They keep track of it in Excel, and then they compare that to the CRM system that they're using, the donor management software. That allows them to kind of have in the back of their minds still any conditional pledges that are out there, so they don't miss the recognition of those pledges when the conditions have been satisfied. The next piece is the net asset classifications. So we mentioned there's with and without donor restrictions. Without donor restrictions is pretty self-explanatory. That's money that's just coming in the door that can be used for any purpose deemed necessary by management. With donor restrictions is where things get a little more complicated. There's two types. There's either temporarily restricted or permanently restricted. We'll give some examples of those later. The other piece on this, there is oftentimes a board designated endowment fund. If that fund is board designated, that's still considered to be without donor restrictions, because the donors themselves have not placed any restrictions on them. It's more of an internal decision by the board to hold those funds for a separate purpose. But it's also important to understand if those board designated endowments exist, because management can't just use those funds for any reason that they deem necessary.
Unless the board allows it. So we'll see that when we talk about liquidity. Board designated endowments are taken out of liquidity, but the board obviously knows, hey, we still have this, we'll call it a kitty of money if we need to support operations or certain programs where we can take it out of the endowment.
And really, why do we care? You know, understanding what donor restrictions are being placed on the net assets helps you understand as an organization what assets you have available to use just for the general operations of the organization. So some examples of temporary donor restrictions. These are restricted by the donor for a specific purpose or time frame. So at some point, the restrictions on these expire. You know, most common examples we see are perhaps a contribution specifically to purchase a new van, or contributions that are received in 2020, but they're designated for the 2021 year. Capital campaign contributions are another common example. There's a lot of confusion sometimes of the difference between a temporary net asset restriction and a conditional restriction. Again, just knowing temporary restrictions, the donor isn't telling you, we're going to give you this money if, it's we're giving you this money for. So they're giving it for a specific purpose instead of requiring you to do something in order to receive the money. And then permanently restricted net assets is when principal must be maintained in perpetuity. These are typically your endowment funds. So a donor is giving you a set principal amount that must be held, and maybe the earnings can be used or a certain distribution amount can be taken out of it each year. But in general, these, I think probably most of the people on this call have heard of an endowment fund. Those are going to be your permanently restricted net assets.
And I think the best thing you still got to remember, there's two different types of endowments. There's permanent endowments, which are donor endowments, and then also that board designated endowment, which we mentioned as well. So keeping those separate and knowing the differences, they're not the same type of endowments, because the board designated endowment is an unrestricted asset because the board can decide to do anything. If the donor is giving you a permanently restricted net asset, it's permanently restricted endowment, it's permanently restricted unless they change their mind, which generally doesn't happen very often.
So this is an example. So within the financial statements, you'll often see kind of a roll forward like this, or maintaining something like this with your organization internally is really important. Basically what this is doing is taking any restricted contribution that you have, showing whether or not it was released during the year to get to your ending net assets with donor restrictions. The reason this is important, as you can see, this is really spelling out what each of these donations are restricted for. Having something like this in place is important. If a donor is to come back to you and say, I need you to prove to me that you spent, in this example, the $500,000 on 2020 operations. It's really easy to do that if you've been tracking those donations in a manner like this. This is really something we do a lot of times, from an audit perspective, but it's also really important for management to maintain something like this so that you know what money donors have given you and making sure that you're using those for the correct purposes.
I assume a lot of you guys use QuickBooks. We would generally recommend on these contributions not to set up a new account in QuickBooks for every time you get a contribution from someone from a different donor. You can put them all in one line item and then also have a separate, this is like a separate schedule that details everything out. A lot of times we'll see some not-for-profit trial balances and using QuickBooks, setting up a new account for every time they get a donation from a different donor. So they have hundreds of trial balance accounts and they try to reconcile it through there, which the best way is to have one line item for donors, and then you have separate schedules to track the net assets with donor restrictions.
And then the last piece, again, I think we covered this pretty well earlier, but is the functional expense allocation. Internally, if you're with management, I think it's important to make sure you're maintaining a reasonable methodology, as well as oftentimes we see a lack of this is keeping some sort of documented methodology, so that let's say someone from your organization leaves, another person can come in and really, be able to understand pretty quickly those allocations. If you're on the board side, I think it's really important as a board member to understand and review these allocations. Again, your 990 is public information. So really having a good handle on the allocations between program management in general and fundraising is important, because I would say this is something I know that donors pay a lot of attention to in some circumstances. Like Sam said, you don't want to see 20% of your total funds are being expended on programs. Well, that tells me that you're not really utilizing your resources in an appropriate manner. And a donor is probably going to come to the same conclusion. So, being a good, board member includes kind of having a handle on the allocation being used, for your expenses.
Do we have any questions or comments, kind of what we went through? Because it's mostly went through a lot of this financial statement stuff.
I haven't seen anything come through the chat yet. A few comments when we were talking about in-kind donations, just what different people have used them for.
Yep.
But again, if you have any questions, feel free to unmute and ask them, or send them in the chat and I'll keep an eye on them.
Okay, thank you.
Yeah, and Kathy, you made a great point in the chat. Legal fees are a great example. If you have attorneys that are doing free legal work for you, as Sam mentioned, that's a specialized service. So you don't want me coming in and donating legal time to your entity. That's not really of any value. So that's a specialized service that otherwise you would have had to pay for as an organization. What's happening here? There we go. All right, so why evaluate financial statements? That might seem like a silly question. First is to make informed decisions, either as management or as a board. Operating results of an organization can vary pretty significantly year over year. That might be okay. The important thing is to ask the question of why. So, as I mentioned earlier, I think that financial statements are a lot more valuable if you have some sort of comparison metric. So whether that's a year over year comparison, a quarter over quarter comparison, or, a budget to actual. So if your organization has a budget and you're comparing that budget to the actual financial results, that really helps, make these financial statements valuable and understand what's going on. You know, something that is kind of a hindrance, and I'll talk about this in a little bit. Financial statements at the end of the day are a backwards looking document. So you're generally looking at financial statements for a period that has already occurred. So how do you take those financial statements and apply them to the future? That's an important part of evaluating your financials. You know, financials are telling a story of what happened, but there's ways to use those to plan for the future, and evaluate any trends, and maybe, you know, stop something that's trending downward or continue something that's trending upward. You know, similarly, financial statements are used externally. You know, it might be by potential donors or grantors, or it might be creditors. You know, you might have, you know, a line of credit or some kind of note payable, and banks are looking at your financial statements to make sure that, you know, they're providing their resources in an appropriate manner as well. So potential donors and grantors, they're a common outside party that's using these financial statements. And what are they looking for? You know, financial health is important, but it also could be, you know, maybe your organization is in, you know, pretty dire need of additional financial resources. Maybe that's because of things, you know, outside of your control. They're also looking to make sure that you're utilizing your funds appropriately, as well as using them to further the mission of the organization. So,
and where they're finding that information is going to be your statement of functional expenses. That, you know, they're looking to see it's a reasonable number, and that it's more going for the mission of your organization.
You know, and donors want to be good stewards of their own money as well. So, you know, it's important for them to have quality financial records for the organizations they're giving their money to. I don't know about you guys, but I don't think I'd feel very comfortable giving $100,000 and, you know, getting a bunch of junk in return as the financial records. I don't feel very good at that point that the money that I gave actually, you know, did anything for the needs of the end user of the organization.
And it may well as it might have, but, you know, they're going to be looking at your financial records, and if they're in poor shape, maybe not on a GAAP basis, or they're not able to be explained very well, it could hinder yourself from getting a donation because the comfort level is not there.
And then, you know, the last piece we talk about here is board involvement. I know a lot of donors and grantors, it's really important to them that the board is active in the organization. That could be financially active as well as just, you know, from a time perspective. So if the board isn't invested in an organization, then, you know, I think a grantor's question is, well, then why should I be? You know, so if you're a board member of an organization, it's important to show that you've committed either some sort of resource to that organization, whether it's your time or your money. You know, there are limitations to consider when it comes to financial statements. The bottom line doesn't always work. So, you know, change in net assets doesn't necessarily indicate how effectively the organization is using its resources. So it's, again, understanding your organization, understanding its goals, and making sure that you feel like, you know, financially you're meeting those goals. You know, I think a common misconception from a nonprofit world is that the bottom line should be zero. If the bottom line is zero, we had the ideal year. We spent everything that we raised. That's not necessarily true because you're not really preparing your organization for the future. You know, as we mentioned, negative results or negative change in net assets doesn't necessarily mean negative results. You know, similarly, zero doesn't mean that you had a perfect year. So again, understanding the different pieces of those financial statements and you know, how those are going to apply to the future of the organization. I think we've covered quite a bit of this. You know, I want to point out the budgeting process here. Financial statements, again, are backwards looking. And so it's figuring out, how do we take that information and apply it to the future? Is that, projections? Are we analyzing our programs? So taking that statement of functional expenses and really evaluating, on a program by program basis, are we making any money? Maybe we're not. If we're not making money, but we think that that's a really vital program to the mission of the organization, maybe that's a way to get to your fundraising team and say, hey, we need to start making more money for this program, because right now, we're spending more than what's coming in the door. Or perhaps you have a program that's not making any money and you're spending tons of money on it, and perhaps it's not really furthering the mission of the organization. Those are things that can, are tangible items that you can see from looking at a financial statement. So financial ratios, this is a lot of language here, so I'm going to cover this really high level. I think the important thing to understand here is there's a lot of financial ratios out there that can help you analyze your financial statements. A couple things to point out here is, liquidity. So liquidity is basically, any assets that could be quickly turned into cash. I think it's important to understand this. We'll use COVID as an example. A lot of funding stopped coming in the door for a while for a lot of nonprofit organizations in 2020. Maybe fundraising events had to be canceled. So what does the organization actually have on hand to continue to pay what they need over the next, period of time?
Yeah, usually they look at it about a year.
Yeah.
Yep.
This is something that's a part of a financial statement. If you were to get, an outside accountant to do your financials with footnotes, liquidity is something that we put in there. That's because we think that's an important metric for the users of the financial statements to understand. Kind of going along with what Sam said about promises to give and evaluating their collectability, do we understand the aging of those receivables? So if you have a promise to give that you were supposed to receive in 2019 and it's 2021 and you still haven't received it, well, maybe that shouldn't be out there anymore. You're kind of overstating the amount of money you expect to come in the door. Those things can be easily identified via, an aging.
Or you set a policy in place. A lot of companies say if anything's over 6 months or whatever it is, the whole thing is reserved or kind of written off, and then if the money comes in, and they record it as revenue when it comes in.
Another thing too, again, the point here is not just to pay attention to the statement of activities and the statement of the statement of functional expenses. You might have future capital expenditures. You might have debt that needs to be paid off in the next couple of years. All of those things are important to understanding the financial need of the organization over the next few years. And that information isn't told through those other statements. Another thing that's, I think, a good way of evaluating is income sources over total income. Understanding if your organization is supported substantially by a couple of donors or if it's supported by a wide number of donors. I would say, typically a wide number of donors is a better manner, but again, that depends on your organization. The important thing is understanding where that money is coming from. So there's three major kinds of financial ratios. The ones I have starred are kind of the ones I think are important. We've covered a couple of them. The fundraising efficiency ratio, what that ratio is telling you is how much money you're spending as an organization in order for $1 to come in the door. So it's an important metric to understand because it helps you understand if your fundraising dollars are being spent in a, prudent manner. Benchmarking is another, valuable tool to use, a way to use those financial statements in I guess, a good manner. If you're not really doing anything to take your results, again, you're just looking at your results and moving on. You haven't really, taken full advantage of everything they have to offer. So try to start comparing against prior periods, maybe create benchmarks, budget to actual is a great manner. There's a lot of really great resources out there for comparison against your peers. NAM is a great resource to use, GuideStar. I have a couple others out there. Just know that there's resources available to you in order to take these ratios and take your financial statements and really start applying some, trending and benchmarking measures to them. And then, there's non-financial measures as well. So as we mentioned before, you might have one board or one donor, you might have 100 donors, you might have 1,000 donors. Start setting goals for your organization on what you want that to look like in the future. Board members, are your board members active? Are your board members engaged? Have we achieved the outcomes we want? There's a whole host of things that you can use to really start setting goals for your organization. Then the last piece here is just, as a board member, and I think it seems like a lot of you on this call are probably more involved in the management aspect of the entity. But board members have a really important role in the organization, and something that we don't want board members to take lightly. Particularly, I think it's easy for board members to look at a financial statement, kind of brush it off as the treasurer's job and move on. It's important for every member of the board to understand their obligations to the organization.
I think the biggest thing on that segregation of duties, as Katie's talking about, most not-for-profit organizations have a small accounting department. So there's lack of segregation of duties, and it's known by everybody. When I say lack of segregation of duties, there's just the journal entries are done by one person, cash management might be done by one person, and that type of stuff. And I think sometimes what you guys can also present to your board is there is a lack of segregation of duties. So you would like the treasurer or the finance committee to be questioning what you're doing, so they're comfortable in what you're doing and asking you the hard questions. You can give them the proof of what you're doing as well. I think sometimes too, I think the board or even readers of financial statements thinks every time they have a financial statement audit, there's no chance of fraud anywhere because the audit's been done and the auditors looked at 100% of transactions and everything's fine. So that's not the case. The audits are not designed to detect fraud or come up with fraud, but they are a good protection against maybe fraud occurring.
Yeah, and Sam makes a great point there. I mean, unfortunately, nonprofit entities are very susceptible to fraud just because, you typically don't have the unlimited resources to have, a perfect segregation of duties. That's why it's really important to involve the treasurer or some member of the board in the controls of the organization. Because at the end of the day, perception is reality. So if you have, someone who's stealing money from your organization and that gets itself in the newspaper, you're probably not going to see the funds coming in the door that you're looking for in the future. So it's really just something to always keep in the back of your mind, always have a questioning attitude as a board member, and just making sure you're being a good steward to the organization.
And I think and management as well, if you're on this call as a CFO, controller, and executive director, challenge your board to ask you the hard questions so they don't have any questions of thinking things, the financial statements are incorrect or numbers are wrong or posted wrong. So welcome them to ask you the tough questions.
All right, any questions?
Questions or comments or things you might want to discuss?
Thanks so much, Katie and Sam. I'm going to go ahead and stop our recording.